Hello, today we have with us Mr. Raghav Iyengar, Chief Executive Officer at Indiabulls Asset Management Company. Welcome, sir. Welcome to Groww Mutual Fund Talk.
Thank you, Groww team, for having me on this program. I love the work that you do. India is a huge country with diverse population. We have, even after all these years of investments, hardly 7 to 8% of the investing population actually puts money into mutual funds. But thanks to programs like this, I hope we can demystify mutual funds, because essentially a mutual fund is supposed to be a simple, easy to understand and a slightly lower risk product as compared to investing into direct instruments.
So please tell us about your experience in mutual fund industry and how you actually got into it.
Well, that's an interesting story. It might take some time. My journey into mutual funds was largely accidental. I am a chartered accountant and a cost accountant by qualification. I've been in the industry now for close to more than 21 years. I love mutual funds essentially because mutual funds cover the entire spectrum of investment products. You have mutual funds which invest in very, very short dated debt instruments. You have mutual fund schemes which put money into equity. You have mutual fund investments which put money into gold. Of late, we've started seeing mutual funds which invest internationally. So to be in a mutual fund company, you have to have a slightly broader understanding of the way the entire financial system works. And that's what really got me very excited. And it's a continuous learning, because as you know, financial markets are never quiet. You have to be in it every day of the week. The other fun part of mutual funds is that you have to take this entire complicated financial system and try and distill it and make it as simple for the final customer. And that's the other exciting part of the job.
So the first question is, once invested, how often investors should check their portfolio?
So first of all, congratulations to the investor who's put money. I think he's taken a very big step. Most people I know keep thinking about investing a lot. Very few actually invest. So congratulations, Mr. Investor. I think most investments are done today largely unknowingly. I think it's investing has now become a bit like a fad. Like my neighbor did it, my friend did it, my colleague did it, my girlfriend did it. So hence I'm putting money into mutual fund. I think the biggest thing that one should understand when you're investing is that you should and always have a goal to it, right? And goals does not mean very difficult for a 25-year-old or a 30-year-old to think about retirement. You just started life. But a goal could be as near term as maybe planning a holiday in the next 2 years. So as long as you have a goal attached to your investment, the longer dated goals I think can be reviewed maybe once a year, the portfolios. But if let's say you're buying, you want to go on a holiday next year and you're starting to save for it, there are very good fixed income funds which are available, which give you similar returns as compared to other alternatives that are available in the market. See, the biggest advantage of a mutual fund is diversification. You're not putting all your money into one place, and it gives you a lot of flexibility. So if you put in, let's say, 100,000 rupees, you need only 10, the balance 90 continues to earn money. That doesn't happen in other fixed income instruments. So if you're a very short dated goal, let's say after 1 year, then yes, you need to keep checking maybe once every 3-4 months. If it's a long dated goal, like maybe a retirement plan or maybe something like children's education, which are typically 10, 15, 20 years down the road, I don't think those need to be reviewed more than maybe once in a year.
So sir, let's move to the second question. What are the key metrics to look out for?
Mutual fund portfolio matrices are reasonably complicated. They are things that need to be studied, right? But having said that, as an investor, let me tell you that it is your money. It is important that you look at your portfolio regularly. More importantly, you review your portfolio regularly. Remember, this is a serious amount of money that you're putting in. It could impact the way you live 10, 15, 20, 30 years down the road. If you invest in a good company, a good set of mutual funds, you will find that a lot of by the time you're 40, 45, maybe 15, 20 years down the road, a lot of your goals would have largely been achieved. You will be financially independent, which gives you a lot of headroom to do whatever you want. You could have a much better quality of life. What are the matrices that people look at is obviously, I think there are the big thing that I would look at most importantly is that yes, as my scheme, the guy who runs my portfolio, mutual fund, the fund manager or managers, do they have the experience of seeing various market cycles? Most people I have seen in the industry today are conversant with only either a bull market cycle like what happened say from 2013 to maybe 17, 18, or people who have only seen a bear market cycle like what we've noticed in the last 1.5 years. I think it's important to understand, like everything else in life, markets move in cycles. So if you have experience of a full cycle, someone who's managing your money, he or she could do a much better job as compared to somebody who doesn't have that experience. I think apart from that, there are a lot of financial ratios. In the equity funds, what I would look at is a ratio called the rolling return, which essentially looks at your last 3-year rolling return is a very good ability to see it. And I think there I would look at consistency, and if I would see any blips, either if it's done too well or too badly, I would question. And that's where sites like Groww can really help you, because I think they have a very, very good customer interface and you can actually get answers to a lot of your questions just by typing it out whenever you want. So these are the two things that I would look at: a qualitative aspect as to whether somebody has really seen various market cycles, apart from the usual routine things that we look at in terms of qualification background. The second thing, as far as quantitative is concerned, especially in an equity fund, I would possibly look at the way the fund has performed on a 3 or 5 year rolling basis and not really worry about the last 3 months or the 6 months or the 1 year performance. In equity, remember, in equity you are buying ownership of companies. Companies sometimes do well in 3 months, sometimes they don't do well for 3-4 years. So you have to give equity investments time for it to really perform. So hence I think that's why I said in my previous question that maybe if you have a long-term goal, maybe once a year, but if you're looking at reviewing it on a quantitative perspective, this is what I would look at.
So the third question is how to avoid panic when markets are not doing well.
That's a difficult question because most people tend to get into markets for the wrong reasons, right? As I said, they get into it because somebody told them it's a great place to make quick money. It's something I made, or somebody comes and it's typically a party conversation that, hey, I made so much money in this stock, it doubled. And obviously markets are markets, right? They represent the underlying economy, right? So if the economy is not doing well, or like in today's context there's a lot of stress about the trade war and various other issues, obviously the underlying markets will not do well, I think. But the most important thing is that if you attach your investment to a goal, I think you will find yourself to be far more peaceful. Because if I put money into equity today and I know that I'm keeping it for my retirement, which is say 15-20 years down the road, I'm not really bothered whether the last 1 year has given me a negative return or not. 2-3 other things which I've quickly done in my life which has helped me is that I find that more negative the news flow and the more negative the sentiment, I think that's a very good time to actually put money into equities. In fact, most people do the reverse. When you see foreigners selling like they have in the last 1.5 months, and for reasons not related to company performance, like right now one view that they're possibly, that various market pundits believe they are selling is because of the whole slight change in the tax structure. Maybe that could be a good time to put in money. So typically when there is doom and gloom, that's the time one should actually be taking up their equity allocations, and vice versa is very, very important. See, most of us in the individual space are very good at buying things. What we are not good at is selling it, and that's what you really pay a fund manager for, because to take away the emotion from the selling. And remember that all decisions are not profitable decisions. So sometimes you may make a decision to buy into a particular company based on a certain set of data that you have, and then suddenly something could change which could make that data very irrelevant. Or so you will have to have the guts sometimes to take it out at a loss. And remember, it's money, so the faster you take it out and the faster you redeploy it into a better performing company or a bond or whatever, I think you will find that your chances of making money go up that much more. And that's where a mutual fund really helps. So if you have a product, like we have a fund called the Equity Hybrid Fund, which uses something called the CAD model. CAD is expansion is current account deficit. So we found that to be a very interesting metric of telling us in which sectors one should be in and at what duration of portfolio one should be. Because a hybrid fund is actually a great product for a first time mutual investor. It puts a little bit of money into equity and puts a little bit of money into debt. So at various points of time, both of these tend to cancel out any shocks that may happen, like what has happened in the last 6 months. Hybrid funds have done reasonably well in the market compared to, let's say, a small cap fund, which are slightly higher on the risk quotient. So I think the CAD meter, for example, tells us that if the CAD is very high, then we should ideally be in defensive stocks. and we should have a slightly lower duration of our debt portfolio and vice versa. So as long as you have built-in investment mechanisms which are able to rebalance your portfolio automatically, you should not worry about the recent market situation and panic. In fact, by doing that, you're actually taking away a very good opportunity for you to make far better return. Remember, the people who made money in the last bull run were people who came in before the election, not after the election. The man who got money in 2013 is yet, even today, after all this noise and stock markets going haywire, is yet sitting on a very, very healthy return. Lastly, I believe that if you are in a large cap fund, let's say Indiabulls blue chip fund is a great large cap portfolio, 95% of the companies are industry leaders. Those companies will do well over a period of time. So yes, you will see some periods where your returns will be a little in single digit, maybe sometimes they'll be even negative, but equity as an asset class will give you returns over a longer period of time. So the more patient you are with your money, the more return it tends to give you back. But unfortunately, the vice versa also holds true. Is that most people are very impatient with money when they see negative losses. They panic. And that word you used was absolutely correct. They just completely panic. They say, I put money for 3 years. Mera SIP chal raha hai, 3,000 rupees a month. It's now whatever, almost a lakh of rupees, and it's less than even principal value. Had I put money in a bank 3 years back, I would have got so much money. That's all nonsense. I mean, remember, so if as long as you put money and you've linked it to a particular goal, let it go towards that goal. Don't unnecessarily worry about it. Worry if you believe that the scheme is doing something which it should not be doing. So in a large cap fund, for example, there is a provision for fund managers to put money up to 20% into any other stock category. So if you are a conservative man, you want to be in a fund which is purely large cap, and suddenly you look at the portfolio and you see, hey, this has got 20% in small cap, then I think that's a question that they should ask your team and say, and maybe at that time you could look at some portfolio rebalancing. But just because market falls 4-5% and the news flow is all negative and people are all very worried and cocktail conversations and pub conversations are all about the way life is getting bad, I think that's in fact the ulta time to actually cut down some of your consumption, postpone buying that extra set of perfume or take that extra dinner out. That's the time to put more money into funds when things are really bad. My experience of the last 21 years has told me that when you invest contra to what the market is telling you, I think that's where you actually make a far better return over a period of time.
So sir, let's move to the next question. No fund is rated 5 stars. So when should a person decide to shift to a different fund?
See, 5-star rankings are again a combination of various things. They're a combination of the quantitative factors. When I mean quantitative, they look at the last 1 year, 3 year, 5 year rolling returns. They look at how much the portfolio has been churned. They look at the expense ratio. They look at a variety of things. And there are various agencies and companies which do this. Right? There is Value Research, there's Morningstar, there's so many, CRISIL. Everybody has a star rating system. I think if you try and keep chasing 5-star rated funds, it's in some sense a little bit like a dog chasing its tail, because at some stage you'll keep going round and round. So I would say that I think even if the fund is rated 3 and 4 star for a long period of time, it's worth continuing to be invested. If a 5-star fund suddenly gets to 1 star, 2 star, obviously then they have to ask a question. But if a 5-star fund goes to 3 star or 4 star, that's no problem. They can continue. In fact, I prefer to put money into a 4-star fund, because if you're in a 5-star fund, sometimes you tend to for the sake of maintaining that 5-star, you tend to take sometimes risky decisions which can actually bring your rating down much more. So as long as the fund is in the above average category, which is 3-star plus and above, as long as there's no fundamental change in what the fund is doing, as long as you are having a broad overlook of the portfolio and you find you're not too stressed about it, I think you can continue to maintain your investments in these star ratings. But again, as I said, don't rely only on star ratings. It's your money. Don't say, hey, it used to be XYZ, gave it a 5-star rating, that's why I put money. No, that's not. He's not putting the money, you are putting. So it's just an additional input for you, dear investor. So please make sure that is only one part of what you should be seeing. And do a little bit more homework. I think we spend more time researching which iPhone to buy rather than which things to invest. And now, thanks to various platforms and companies like Groww, you have ability to get the information that you want. So please use that ability. Please take informed decisions. The more informed you are when you're taking the decision, the more comfortable you will be when markets keep going up and down like they have been. Right?
So let's move to the last question. How important are the holdings of a mutual fund, and should investor look out for the holdings? What are the holdings of a mutual fund?
So I think about a year and a half back, SEBI, our regulator, Securities and Exchange Board of India, which regulates the entire capital markets in India and obviously mutual funds, came up with a very interesting set of guidelines or set of rules. So now every fund house is allowed to have the fund schemes are very clearly defined. A large cap fund, for example, has to have a minimum of 80% of its investment in the top 100 companies and 20% in other companies. A mid cap fund has to have its investments between 101 to 250. A debt fund, for example, a short term bond fund cannot go beyond more than 3-year duration. So they have given very comfortable buckets for people to understand. So maybe prior to that regulation, I think the mutual fund world was very, very khichdi oriented. So everyone would come out with different schemes, and it's a little bit like old wine in a new bottle, more from a selling perspective. But I think now with this new regulation coming into play, you will find very clearly demarcated portfolios. So if you're in a large cap portfolio, you know that the regulation does not allow the fund house or like Indiabulls blue chip. Even if I want to make it, I cannot make it less than 80% large cap. That is the top 100. That's a rule now. And SEBI is very, very tough on enforcing these rules. So these are all, like in our company, this is built into our risk management itself. So even if there's a mistake, the system itself is not allowed to do it. But if you're finding a lot of volatility in the portfolio, let's say in a large cap fund, the portfolio should be largely not very volatile. And what I mean by volatility is that you should not have too much movement in the returns on a day-to-day, week-to-week basis. If you're seeing that, then maybe you should look at the portfolio and just see what is it that the fund manager is doing. And obviously, by looking at a set of names, you may not be able to understand, especially in the small cap and mid cap space. There are many companies that most people would not hear about. In the large cap space, yes, there are all industry leaders, they've been there for a long period of time, so the names will come to you. And if you're finding too much volatility, or if you're finding that suddenly your returns have gone negative, or a fund which was doing very well, let's say till maybe 6 months back, has suddenly stopped, I think that's the time to again ask and find out what happened. It may be that entire segment has not done well, in which case there's really nothing to worry about. But it may be that maybe then the fund manager or the fund house has taken some unnecessary calls, which may then question your ability to stay in that fund for a longer period of time. So I think mutual fund holdings are a little more complicated to look at. Yes, as an industry, SEBI has made us very, very transparent. So every 30th, 31st of the month, by the 10th of the next month, all mutual fund schemes have to put their entire portfolio, whether it's a 5 rupee investment or a 50 crore investment or a 5,000 crore investment, all of it has to be put in a public domain, which is our website. An investor can go there, quickly look at it, and there's a huge amount of information available. So as an industry, we are super transparent. Our NAVs come out every day, so you can literally track our performance on a day-to-day basis. Our portfolio fact sheets come out every month, so you know exactly where your money is invested. So yes, because as I said in the beginning of this conversation, that it is your money, dear investor, so it's your job. It's ultimately you should have a look at it once in a while. But if there are holdings, don't do a PhD on it. The idea that you've given the money to a mutual fund is that you've taken away the stress of managing it yourself on a day-to-day basis. If you start getting into that, why did he buy this and why did he buy that, maybe then you're better off not putting money into a mutual fund and actually running your own investment portfolio, which has its own set of advantages and disadvantages, right? But for someone like me, I am somebody who trusts my mutual fund. I have almost 90% of my money is only invested into mutual funds right now. At this point of time, I'm largely in the large cap and in the equity hybrid space. But yeah, if I see some opportunity, I will move into other categories. But right now, this is where I am. Because fundamentally, then that allows me to do what I want to do rather than sitting and staring at a screen and trying to understand various names and ratios and analysis. It is not something that excites me very much. What excites me is coming and having conversations like what we are doing right now. So I'm very happy giving my money to a mutual fund manager and asking him to charge a bit of a fee for it and let him run my portfolio for me through a set of schemes. But there are many people who love trading and love buying and selling stocks. Maybe then that's a different type of person. But you remember one thing, that in a mutual fund you get diversification, you get a lot of convenience. More importantly, you get liquidity, because anytime you want, if you want your money, you can redeem today within 3 days. It's my job then to provide that liquidity and give it to you. As an individual investor, you don't get all these things, so you should keep these in mind. I'm not saying one is good and one is great. Obviously, that's not the case. That depends on person to person as to how you live. So I think to sum up my conversations, I think, remember, dear investor, it's your money. Please attach your investments to a goal. Please be aggressive when people are fearful, and vice versa. Please be fearful when people are aggressive. So ideally, in hindsight, if most of the times if we had actually been selling our investments or reducing our level of equities when FIs were really buyers, we would have been probably in a better situation. When you are buying, if you bought when newspaper headlines are in panic, maybe that's, or when you see big headline, index falls 1,000 points, maybe that's a day you should start thinking about buying, not thinking about selling. It's a very, the investment part of it is an art and a science. The science, obviously, we all know, we talk about the various ratios, the company analysis. The art part of it is being emotionally tough. It's very, very difficult to be invested, and more importantly, to add more money when your existing holdings are not doing well. But trust me, that's how the greatest investors in the world have actually done very well, by being patient and investing in a set of high quality companies. I would urge you to consider Indiabulls mutual fund as an investment option. We do have 3 funds at this point of time on the equity space: blue chip fund, equity hybrid fund, which used to be the balance fund, and a tax savings fund for real assets. On the fixed income side, we run 2 very high quality funds: the savings fund for investments up to for about 3 months and above, and a banking and PSU fund which buys high quality PSU, public sector debt. For these are things you should keep for a long period of time. I think debt investments are an area where you must look at. Debt mutual funds give you big advantages, in the sense, one is that they take away the reinvestment risk from you. Number 2, they give you the flexibility of adding on or reducing how much ever you want. In other instruments, you have to take it as a block and put it back as a block. They give you access to huge liquidity. Most debt funds pay you your redemption back in 1 business day. So if you redeem today, tomorrow morning money is in your account. They are the best suited for your short-term goals. So if someone comes and asks me, like last evening when I was on a flight, somebody met me and said, "Hey, I've got to buy a house in 3 years. Which equity fund should I put money in?" I don't think if you have anything less than a 5 to 10 year horizon, equity is not the best place for you. So I had to tell him that, say, sir, equity is a bit of a, for 1 to 3 years is a bit of a sattabaji. I don't do sattabaji. You may get a better return, you may not, but equity, you need time to give you that return. So debt funds provide that thing to you. So as I said, they give you flexibility, they give you access to a high quality portfolio, and you should look at debt. I mean, irrespective of all the noise that's happening around debt funds, it's a very, very small part of the total pool which is in a bit of a stress right now. But so don't ignore the larger pool just because of this. On equity, please stay the course. As somebody who's been in the industry for 21 years, made plenty of mistakes in the process. I can only tell you that I wish I had similar platforms like Groww advising me when I started my career or in the middle of my life. I would have possibly avoided making many of those mistakes which I'm telling you today not to make, which is redeem and panic. Keep looking at your NAVs daily. Don't do that. Let the fund manager do his job. You do yours. If you're the type of person who wants to do that on a regular basis, then maybe mutual funds are not for you. Then maybe you should look at a trading platform or a direct equity platform. But enjoy life. I think India is one of the few countries in the world where you are getting some level of growth. I think I'm very positive of the overall Indian space. Yes, we tend to forget it in our traffic and our other problems that we encounter on a day-to-day basis. Bangalore has a big traffic problem, Bombay has a traffic problem. These are 2 cities I'm very familiar with. Other cities have their own problems. We tend to forget about it. But remember, investing is a journey. Enjoy it, have fun, and all the best in life. Thank you very much.
Thank you, sir, for taking time out of your busy schedule, and that was a very enriching and knowledgeable session.
Thank you.
So, as sir said, if you have a financial goal, you can start investing.